Sea Limited used to be called the Amazon of Southeast Asia, but the company reported earnings last week and the stock collapsed by 33%. At the current price, the company has a market cap of $21.8 billion. It's got $7.7 billion of cash on the balance sheet and $3.4 billion of debt, so the enterprise value is $17.5 billion. Revenue over the last 12 months is $12.7 billion with $271 million of net income and $1 billion of adjusted EBITDA. To better understand the company, we can look at the three main components. E-commerce is the company's biggest revenue driver. This segment produced $2.1 billion of revenue in the quarter, which was up 21% year over year. Adjusted EBITDA for this segment was $150 million, which equates to a margin of 7.1%. Digital entertainment includes the company's gaming business. This segment reported revenue of $529 million for the quarter, which was down 41% year over year. Adjusted EBITDA for this segment was $240 million for an EBITDA margin of 45%. Digital financial services includes the C-Money digital payments app. This segment grew revenues 53% year over year to $428 million. Adjusted EBITDA was $137 million for an EBITDA margin of 32%. What's interesting is that the company posted adjusted profits in all segments, and that's largely due to the company massively cutting costs. Sales and marketing was cut by 49% to $500 million on the quarter. So why did Sea Limited take such a sharp tumble? It's hard to pin down the exact reason, but there are a couple of explanations. First, total group revenue was up only 5% on the quarter, which was below analyst estimates. It's important to note that Sea used to be growing much faster than it is now. Revenue growth was 100% in 2018, 163% in 2019, 101% in 2020, and 128% in 2021, so this is a significant slowdown. Second, management signaled that it's going to switch its focus on profits back to growth, specifically in the e-commerce market, and that means e-commerce is going to slip back into the red. The Southeast Asian market is extremely price sensitive and competitive with large rivals like Alibaba, Grab and Amazon. TikTok has also been signing up merchants in the region and quickly gaining market share, so investors need more evidence that Sea Limited can maintain its position. Looking at the individual parts again creates some perspective. E-commerce is incredibly competitive, so profits from that segment are unlikely to be material for some time. The gaming segment is profitable, but it's showing significant revenue declines thanks to the falling popularity of the company's Free Fire game. So the real value in Sea Limited comes from its financial segment. This segment is showing great revenue growth year over year, but its quarterly growth was less than 4%, and management stopped reporting figures for active users and total payment volume, which is a bit of a red flag. All that said, Sea Limited has cash on the balance sheet, and the stock was once valued at over $180 billion. Value the parts individually and the stock does look undervalued. But Sea Limited has no fulfillment, and the company made some poor moves in the past, such as trying to expand in Europe. This is a very difficult market to succeed and make money in, and for that reason I give this stock a neutral rating. But these are my personal opinions, not financial advice, and I've got no position in Sea Limited. For more detailed analysis, make sure to visit our website overlookedalpha.com.